Hey everyone, this is Mark Treichel with another episode of With Flying Colors. I'm excited to be here today with Dan Prezioso of Olden Lane. Dan, how you doing today?
I'm doing great, Mark. Good morning. It's good to chat with you.
Yeah, good to catch up with you. You've been on the podcast. I think maybe this is the third year in a row, maybe fourth year that I've had you on the podcast. But for those listeners or watchers who haven't seen the older episodes, could you give a little bit of your background and Olden Lane's background and what it is you do in the credit union space?
Sure. I'm a partner at Olden Lane, and our firm is a investment banking boutique that is dedicated to credit unions. We formed ourselves and started focusing on credit unions about around 2017. We were a group of capital markets professionals, financial engineers that didn't have a very long background with depository institutions, but a long one in capital markets. And we formed a group that was looking for gaps in certain markets where a small firm could make a big impact. And one of our thesis at the time was that credit unions were underserved from a capital markets and investment banking standpoint. And one of the things we were observing that we formed that thesis around was that credit unions were not, by and large, raising capital in the form of subordinated debt, even while at the time about half the industry had the low income designation and the ability to do so. That market was very still and had very little activity. So we started to probe there. Long story short, a lot's transpired in that market. You and I discussed it in September of 2022, as you mentioned on this podcast. We've been able to help credit unions issue over $1 billion of subordinated debt and supplemental capital. Of course, a lot of our clients that are interested in supplemental capital are looking for growth. That was, one of our theses is that this capital could be used by strong credit unions and want to grow for a period of time faster than maybe their ability to retain earnings in that period. And acquisitions is a classic use case for supplemental capital. So we also assist clients with mergers and acquisitions. And last time we spoke was about 2 years ago, December 2023. And what we spoke about at that point was our expectations coming out of the small banking crisis after Silicon Valley Bank and Signature Bank blew up, and the very aggressive rate hiking cycle caught a lot of banks and credit unions off guard. And as well as a lot of trends that accelerated during the pandemic, including, this shift in consumer tastes to really advanced digital banking capabilities, the aging of leadership, in addition to all those earnings pressures at the time. We prognosticated on your podcast at the end of 2023 that there was going to be a more interesting consolidation cycle. We were going to see more credit unions that were bigger and able to exist independently, actually choosing to combine for strategic purposes to reach for scale. And that is something that was good prognostication. Of course, we've seen that. We've seen sort of the strategic merger activity, which I define as mergers between credit unions where both sides have at least 100 million in assets, really at a higher level and with more frequency than we've seen before. And I could just show you a little chart what the NCUA merger approval activity looks like with respect to strategic mergers. And, right after we spoke in 2024, there was 18, which was almost a several year high. There was 19 prior in 2022. But then this year, we're going to break a record. In the middle of the year, the NCUA has already approved 14 of them. Of course, everyone's seen the headlines. We've seen some massive mergers, First Tech and Digital, Boeing and Safe, Wings and Ant. And so it's obviously a trend and a fashion now. And it's something that we expected. I think the next era is going to be interesting. It's what, I'm interested to talk to you about today. We've seen some of those factors abate. Earnings are rebounding now. They're almost back to where they were before the rate hiking cycle. And the interest rate environment is now very benign. In fact, the net interest margin is a 20-year high. So that's going to alleviate some pressure on credit unions, but we do think that there's challenges ahead that will definitely be a factor in consolidation. And I know our clients, and I think the market generally is sort of interested in consolidation and inorganic growth opportunities that come from it. So I think this discussion is one that those sorts ought to pay attention to.
Got it. Yeah, it looks like when you hear you rattled off the names of the big mergers out there, two or three of the biggest ones. But when you see that chart and you see that by the middle of the year, they've almost matched last year as far as these strategic mergers, if as you call them. Fascinating. You predicted kind of where it was going, and B, to see the data kind of picking up steam and seeing that chart is eye opening. So, you and I chat a little bit before the show about different things that you think might impact those strategic mergers and credit unions in general. What do you want to tee up first in that regard?
So now, obviously, we're always trying to look at this market and kind of position ourselves a little bit ahead of things to come. And one thing that we're aware of, and I think everyone in the industry should be aware of, is the fact that significant demographic transitions are really powerful currents that shift markets and shape economies. And if you think about where we are today, we are at the inflection point of a very significant demographic transition, which is the succession of the baby boomer generation. And what I mean by that, if you think about it, just this year, the most senior baby boomers that were born in 1946, which is generally considered the first year of the baby boomer generation, they turned 79 this year, which is the average U.S. life expectancy.
Wow.
The most junior baby boomers who were born in 1964 are turning 62 next year. Last year, Mass Mutual, did its retirement happiness survey, national survey of retirees, and it concluded as part of that survey that the average retirement age in the United States is actually 62. So we have a situation now, demographically, where this very significant generation, both in terms of size and its economic impact, is now at a point where they're going to be transitioning assets to beneficiaries and reaching a point of full retirement. So their impact in banking and the economy is going to shift profoundly in these years to come, where they're not going to be as prominent as savers. And of course, we're seeing their activity in terms of their total outstanding debt shrink considerably, and that's to be expected. Another thing that is going to be interesting about that transition is that baby boomers are not measuring very strongly when it comes to retirement readiness. So about half of them, according to analysis by Vanguard, are actually not very well funded for their retirement. If you think about them as savers and depositors, it may be a situation where as they get older and really age into their latest years, they may start drawing down their savings quite considerably and rate shopping quite aggressively to make the most out of the savings that they do have. So that's going to be a significant shift for banking, and that's one that I think this industry has to position itself for. And it begs the question, how well positioned are we right now for that? And the data doesn't look great on that, but I'll pause and
Okay.
allow you to
Yeah. So,
prompt me.
so 62 is the average retirement age, and half of those that retire don't have enough saved up to achieve that. And taking an average in another number of half, you can draw some conclusions tied to that. And thinking about what you just kind of unpacked on credit unions is these folks aren't going to be borrowing. They are your big savers. They are your big depositors. But since they're not as ready as they might need to be, they might burn through some of those savings a little quicker. You're setting aside, do you take Social Security at 62, 65, 67, all those things that people have to start thinking about. And then you throw in it, the one thing you didn't mention because we've gone through this inflationary period, right? So maybe they've always planned on retiring at 62 or 63. Yeah. What is it? Sequence risk, right? What the market's high right now. You walk out and decide you are ready to retire, and then the market gets hit by 20%. And oh, by the way, we've had this huge inflation. You could see credit unions challenged to grow, right? Through just maintaining their own member balances.
Yeah, well, that's absolutely true. I mean, the sort of the fiscal dominance, which is kind of this overarching theme of the macro environment, in combination with this demographic transition, is I think going to be the story and what credit unions need to appreciate as they think about how to engage their markets. In terms of the baby boomers and their transition, baby boomers have really dominated the economy for the last generation. And I just pulled up a chart for you and I to look at that just shows the distribution of household wealth. And the baby boomers have been the majority of it for dating back since before 2010. But it peaked in 2016 at 58%. Baby boomers are 58% of household wealth in this nation as of 2016. It's down to 51% now, and it will be less than the majority, probably next year, I would expect, if not definitely the year after. And then, so now we have to look to the rising generations. And, baby boomers obviously were born during a very significant spike in birth rate after World War II. So, they are sort of, thought of as a giant population. But in fact, as of 2019, millennials are the largest part of the US population and at 22% almost. And Gen Z, which is the younger than millennials, they are actually the second largest cohort of the population at 21%. The baby boomers are shrinking; they're less than 20 now, and Gen X is the smallest generation between the four of them. They're almost at 19. So, just from a sheer standpoint of the number of individuals out there, the baby boomers are shrinking. They're going to shrink from a standpoint of the number of consumers as well as the amount of assets that they control in the economy. And they're really going to be migrating their assets to millennials and Gen Z. And we're going to see a significant rising of those generations from the standpoint of who influences the economy. And I think banking needs to consider that. And when you think about inflation, it's going to be a struggle for both those generations, and it's going to impact their behavior. But I think we need to really focus on how millennials and Gen Z are reacting to it, because that's going to be, from a banking standpoint, what's going to start driving performance and balance sheets.
Yeah.
And that's where I think credit unions need to assess sort of where they are relative to those generations. And one of the things that I would say concerns us is that some of the survey data doesn't look great. And just to emphasize, reasons to expect this rising, and I think they're intuitive, so I don't think I need to harp on it that much, but just to show you that these things are transpiring this year, sort of in front of our eyes. In terms of savings, Santander Bank just did a survey, came out in August, and they determined that the majority of Gen Zers and millennials have increased their savings this year, through the first half of 2025. About 58% of Gen Zers and 54% of millennials increased their savings. Conversely, Gen X and baby boomers, a majority did not increase their savings. In fact, only 39% of baby boomers increased their savings. So, 60 presumably have declining savings. And that's kind of what we're cautioning here, is that that's probably going to accelerate in the years to come. And then when you look at total debt balance by age, millennials and Gen Z are driving all the growth. Total debt balance of Gen Z in 2025 so far compared to last year is up 32%.
Wow.
And millennials, a strong growth rate over 7%. Gen X is mostly flat, a little less than 2% growth, and baby boomers are shrinking, as you would expect. And of course, the silent generation over 80 years old shrinking even more so. And those be the trends. Now, I think that growth rate on Gen Z is quite eye-popping. Whether or not it's too much growth, I think it is something to consider. But this is where banking is going. It's going to have to focus on these generations in order to generate the growth and performance going forward. They are where the action is.
Well, and when I think through with my lens as a baby boomer on the young end of the baby boomer side, and the frequency at which I used to walk into banks versus today when everything's online, and even me in that generation having embraced technology, every generation that follows that is more into technology, is more into fintech, is more into less traditional type of banking, if you will, credit unioning. So where do you, the Wayne Gretzky and, credit unions want to kind of skate where the puck's going. Where do you, what should credit unions be thinking about in that regard with the younger generation, and what are the risks that are out there if they don't, you got a board of directors that looks like me, that is my age or older. You got management that is my age or slightly younger than me or slightly older than me, and none of them are borrowing and they're not saving as much. What should those credit unions be thinking about? And where might these other generations be taking credit unions?
Sure. Let's start with
It's a lot there. I said a lot there. So
no, great question. That is the question. Let's start with what are the risks? I mean, and that conversation I think starts with how are credit unions positioned for this? And I've kind of alluded to my concerns that they're not positioned well. So let me support those concerns. We've seen survey data in the last couple of years that are kind of concerning on this point. In 2023, McKinsey did their consumer life study, and they looked at banking by household primary financial institution type. And what they determined as part of that study was that credit unions had really concentrated between 2015, which was the point when they did their last study, and 2023. Credit unions significantly concentrated their membership in baby boomers, so that baby boomers, whereas in 2015 comprised 28% of credit union memberships, by 2023 they were 39%.
wow.
Whereas millennials actually shrunk during that period from 24% to 21%, and Gen Z members didn't budge or grow whatsoever. If you compare that to banks, in 2023, bank customers, 29% were boomers and 29% were millennials. That's a better alignment, and I think where you'd want to be. Credit unions look misaligned here. And then when they looked at recently opened deposit account market share, those numbers were concerning as well for credit unions, because in 2023, and that's something they look at more frequently on almost an every 2-year basis, it was a multi-year low in 2023 when McKinsey looked at this for credit unions with 10% market share compared to 15% market share in 2021. And it had been about 15% market share dating back to 2015. So it showed that the credit unions had been perhaps too reliant on baby boomers, and it was starting to show as an engagement deficit relative to younger generations, which was impacting recently opened account market share. That data is from 2023. Last year, Aperture, which is a digital banking tool provider for credit unions and banks, commissioned Harris Polls to do some surveys as well. And that also found that when it came to primary financial institutions, millennials and Gen Z were less often utilizing credit unions as a primary financial institution. Millennials about 10% less, Gen Z about 35% less than the rest of the population. And then, this year, Payments Intelligence did a survey. I think this one had about 16,000 consumers as part of the survey. And they looked at Gen Z credit union members, so members of credit unions that are Gen Z, and they found that 37% of them in their survey were at least somewhat likely to switch to another financial institution over the next year, compared to 15% of other credit union members saying the same thing. So more than twice as many Gen Z members that were already banking with credit unions were looking to switch, and a far lower number of Gen Z compared to other credit union members were certain that they would stay. About 42% of Gen Z relative to 74% of other members. And numerous conversations that we've sort of had in the market sort of validate these numbers. We've seen several calculations of average age of credit union members show that they're drifting up into the 50s. And these numbers don't look good when you consider the demographic transition that we're talking about. So that's a concern. It's something I expect to see in the numbers, but as I said, the performance numbers kind of look good because of the net interest margins being so benign. But you can see in the data some hints at this engagement deficit. I mean, one thing I like to look at is growth, but I'm starting to look at real growth more often, just because with the fiscal dominance and the money circulation and the inflation, real growth is sort of an interesting measure. So I pulled up a couple charts here that show, real growth of total member deposits alongside nominal growth as well, not ignoring nominal growth, but looking at the real growth story as well. And then the growth of the average member relationship versus the nominal growth of that relationship. And that's total balances of deposits and loans. And as you can see, the real growth looks very constrained, and it's barely recovered to positive territory when it comes to deposit growth. And when it comes to the average member relationship, we're still negative from a real growth standpoint. And we've been negative since 2021.
And
So,
Dan, so real growth would be deducting out the cost of funds that you're paying, right? So if people,
it's deducting out CPI. It's deducting
okay.
out the rate of growth in the consumer price index. So we're taking inflation out because some growth, nominal growth, inflation driven growth is just going to increase money everywhere, essentially.
Sure.
So I want to see what that looks like. And the reason why I look at that is because, this OpEx ratio. And where we think about what the consolidation pressures are now, I think it is the expenses, the increase of expenses in this OpEx ratio. And when you have a real growth deficit, you would expect to see some pressure on OpEx ratios. And that's exactly what we're seeing where, during the pandemic, OpEx ratios collapsed because of the surge of asset growth. And we got a lot of efficiency producing technology. So you would like to see the industry harness some of that efficiency. But what's happening is that OpEx ratio on average across the industry is drifting right back to where it was. But what's also interesting is this incline. As you can see, we're looking at a chart, and I know a lot of your audience is probably audio only, but this chart shows the OpEx ratio sort of bottoming in 2022, and then it takes off like an airplane leaving the runway. And you rarely see a line that's over so quarters quarters this smooth. I mean, it's not really bouncing at all. It flattened a little bit in 2023, but then it just steepened again, and it just looks like it's taking off. And I think that's the consequence of the real growth challenge that we were looking at on those previous charts.
Sure.
And then another thing that may hint as well at this engagement deficit with the younger generation is the fact that we're not really seeing credit unions showing a lot of evidence that they have pricing power in the deposit market. The Fed has started to cut rates. They started to cut rates in the middle of last year. And of course, you're going to see a lag. The cost of funds is not going to reprice in lockstep. It's going to lag those cuts, but we're not seeing any evidence that the cost of funds is budged up. It hasn't budged at all. It's exactly where it was in the first quarter of 2024, but before they started reducing rates, which suggests that there's really no pricing power that credit unions have. They're still having to offer generous rates to get deposits. And I think that's an indication of the engagement deficit as well. But my expectation is that we haven't really seen anything yet. We're just seeing hints of things, perhaps, but this is going to get more problematic if that survey data is an accurate depiction of where credit unions are relative to these rising generations, and it doesn't improve. It's going to these issues are going to get more apparent and more difficult to manage.
Well, and three things kind of running through my head that the younger generations are saving more. The baby boomers are saving less and tapping into their savings. Yet, over the last 10 years, the concentration of deposits in baby boomers has gone up, despite the fact that they're saving less and the other generations are saving more. Older generation is stickier in that they'll stay with their institution. The younger generations aren't as sticky. They're more likely to move, which uh, can be it can be glass half full, is that if you market to them and if you embrace this and you figure out how to bring them into the credit union, they may be willing to come. So there's that opportunity. But if you don't embrace that, they're also the ones you have could be going to the banks or to the non-banks, to the other fintech options out there that might be brewing.
That's exactly right. I think credit unions have an opportunity here. I don't think that there's any reason why credit unions can't be a fantastic financial partner for millennials and Gen Z. I'll say this though, they're not presenting themselves as one now. And I can say that as someone who is a millennial. I was born in 1982. I'm a senior millennial. The team that I'm working with at Olden Lane to research this subject are mostly very smart analysts that are Gen Z. All my friends are millennials, all their friends are Gen Z. I think we know something about what appeals to our generations, and credit unions are not delivering on that. And I don't think it's because they can't, but for whatever reason, we're not really seeing a really compelling set of offerings from credit unions that are going to drive that engagement. So I kind of believe the data because, it's the best information we have, but also it aligns with what I'm just feeling qualitatively as, one of the consumers that is, part of this subject here. Now let's talk about those that, that are engaging with millennials and Gen Z, and what are they doing and what's their experience like? And what are they in terms of the competitive pressure relative to credit unions? One of the things that I think credit unions have to appreciate about these younger generations is their challenges. What are their financial challenges? Well, we've talked about the cost of living, right? Um, Severe increase in cost of living, and in particularly the cost of housing, so that the average median first-time home buyer is now 40 years old. A 40-year-old a 40-year-old home buyer is not someone that, has been saving for a down payment for a few years. A 40-year-old home buyer is someone who's been working 15 years and investing the entire time for that home ownership dream. So I would ask credit unions listening, what are your investment options that you're offering to those aspiring home buyers in these generations? They perceive that their savings are being eroded by the cost of living increases. What are and they want to invest those savings to keep up. What are your offerings? And if your offering is LPL, financial advisor, that's not what the generation wants.
Right.
That's they're looking for. That's not where they're going. Where are they going? They're going to Robinhood. And what's Robinhood doing? Robinhood is now offering mortgages through Safe Home Mortgages, which is a digital mortgage origination. They have a partnership. If you are a Robinhood Gold subscriber, you get below market mortgage rates at least 75% below the national average through Safe Home. And you get a $500 credit on closing costs. So these platforms are getting into banking. They also issue their gold subscribers credit cards with 3% cash back and high yield savings. And we can look at their performance. It's pretty fantastic. That gold subscription, let's look at its growth. In 2023, Robinhood Gold subscribers, they had 1.4 million subscribers at the end of 2023. At the end of Q3 of this year, they had almost 4 million. It was a 77% increase since 2024. The deposits, the bank deposits that are on their platform is up to over 35 billion,
Wow.
which is a 44% increase year over year. And if we look at their August operating report, which shows us a breakdown of those deposits, 95% of it almost is from those gold subscribers. So these investment platforms are offering banking and are banking their clients. SoFi is another, and my partner Mike Macurola just this month published a op-ed with Typhone called "SoFi versus Credit Unions." SoFi, of course, known as a student lender, they opened a bank in 2022, and they've been growing. It's amazing, their growth, very prodigiously. And in fact, last quarter, I think it was their best growth quarter yet. They grew deposits by 3.4 billion. And the entire credit union industry in total grew deposits by 7 billion. So this one bank, which is not it's not a behemoth. As of the middle of this year, it wasn't even among the top 50 banks. It wasn't even in the top 60 banks. The bank only started 3 years ago, but it is a bank that has a very modern investment platform like Robinhood and has a business model that is very focused on being the life cycle financial partner for Gen Z and millennials. And you're seeing the power of that model. They also grew loans even even faster. Their loan growth was about 55% of the entire loan growth in the credit union industry. And in terms of customer acquisitions, they grew about as many new customers as the entire credit union industry grew new members. And again, this is not a top 50 bank. They're growing like a behemoth, but they're not. It's not a very large bank comparably. It's a small regional bank essentially, but they're a national digital bank that has a great model for engaging millennials and Gen Z, and they're getting all the benefits of that. And then there's other out there like Coinbase, which is strictly a crypto investing platform, but they're issuing credit cards now. And I'll give you a personal anecdote on that. I learned about blockchain in 2017 from colleagues of mine that were in finance and were excited about it. And I thought Bitcoin was kind of cool back then, and I bought one Bitcoin 2017. It was only about $2,000 back then. Obviously, when you buy Bitcoin in 2017, you kind of are a little hooked. So obviously I like it. I still have Bitcoin, and I've accumulated some more, but blockchain for me, I don't entirely understand all of that. So it's not like a big part of my financial life, but I've always kept what I would describe as a material but modest exposure to that asset class and that industry. And I've done it through Coinbase, where I have some very passive investments there, Bitcoin mostly, but some others that I just consider my material but modest exposure to that asset class. But Coinbase this year issued a credit card that has Bitcoin rewards. And based on my customer status, I'm entitled to 3% Bitcoin back on all my purchases. And I like that. I like the idea of stacking more Bitcoin, especially how that asset has rose in so much prominence over the time since I learned about it and got involved, and also more recently. So I have the card now, and my top of wallet card used to be a Amazon rewards card, which is nice. Everyone shops Amazon, very simple to redeem the rewards. But now I'm splitting equally between the Coinbase card and my Amazon rewards card. So they've become a top of the wallet card for me. But what's even more interesting is this is very recent. I've only had the card a couple of months. When I went to make my first payment, obviously I use their mobile app. I'm not the most tech savvy millennial. I'll be the first to admit I have a hard time using the printer in the office. So it was late. My payment was due. I clicked some buttons. I made a payment, but I realized I made the payment from my Bitcoin
Right.
holdings, pay the balance with Bitcoin, which was not exactly what I was going for, right? I was trying to add to my Bitcoin position,
Right.
these rewards. Fortunately, Bitcoin, the price of Bitcoin's been going down, so I was able to move money into my Coinbase account and buy it back. But I had to look more closely after that and decide, how I'm going to make these payments. And you can connect a banking account to it. But then, as I'm looking at it, I see that Coinbase is paying 4% on stablecoins. I've never really used stable coins because, as I said, for me, blockchain is just, some of these more interesting assets. It's a way to get exposure. I'm not doing any gymnastics on the blockchain where I need to do dollar transactions on it outside of just, using some cash deposit at Coinbase to maybe buy Bitcoin or something like it. So stable coins have never been interesting to me. But, now I'm looking at it. Why don't I just move some of my checking account balance to Coinbase, keep them in stable coins, earn 4%, and now I could pay my credit card balances with them. So now I get the stable coin. And it's interesting to me that Coinbase is not a platform, is a platform I use, but I never had any inclination that it would ever be part of my everyday finances. Never. But they've drawn me in to the point where now they're capturing my top of wallet credit card activity and and deposits from me.
Sure.
That's how these platforms integrate themselves into the lives of their customers. So I just want credit unions to appreciate when you decide not to offer self-directed investments, not to offer fractional shares, the ability to self-direct ETF investments at your institution, or you decide, crypto is just not something that we want to be involved in. You're telling the younger generations that you don't care about that part of their financial life and you can't help them, and they need to go somewhere else if that's what they want to do. And the places that they're going for that activity are saying the opposite. They're saying, we want to be part of your everyday banking activity. We want to be part of your everyday payments. We want your deposits. We want to be part of your homeownership dream. We want to finance it. We want to be there to support you through all of it. And that's the difference in the growth story. That's the engagement deficit. These are the platforms that are resonating, and credit unions are struggling relative to that. And I think losing the challenge here, and they don't have to. There are a few credit unions that are beginning to offer most or everything that Robinhood can offer and these platforms can offer. I mean, one that I'll mention is Frankenmuth Credit Union in Michigan, where they have a platform. You can buy ETFs, you can buy stock, fractional shares, crypto, right from your checking account, right from your check. You don't have to move money. You don't have to ACH dollars anywhere. Buy it right from your checking account. They have a platform where you can invest in fractional real estate. If the home ownership dream is too out of reach, but you still want to invest in real estate, or if you want to invest in fractional real estate as you build up your savings to get to your own home, they have that available as well. And they have digital tools for budgeting and saving and planning. They have it all. And I was interested to join them. They're a community credit union in Michigan. So I don't know if someone from Frankenmuth has advice for me if I'm eligible to join. But that's, I think, what credit unions ought to be doing. But by and large, they're not. And I think that it doesn't surprise me to see these firms do so well and relative to credit unions. And just on the Coinbase story, just to, close a loop in terms of, their growth, their stable coin balances increased 9% quarter over quarter. That's a 36% annualized growth in Q3. It's up to 15 billion. So we're seeing deposit gathering is difficult. Everyone's saying so, especially in community banking. There's one influencer on X called Community Bank Guy. He seems to be a anonymous CFO at a community bank. He said something that made me laugh a little bit the other day. He said, I don't know how to get deposits other than to buy the people and institutions that have them. And I think obviously our M&A practice is very busy. There's a lot of appetite to grow through acquisition because organic deposit gathering is so tough. But I would just say it's not tough for everybody. There are firms that are growing deposits very rapidly. Look at their model, look at how they're engaging, and I would say, be a fast follower relative to these platforms would be my advice.
Couple general that Coinbase card when you had it up on the screen, that was a very attractive card. I can see how it can get to the top. I mean, the marketing that goes behind that is fascinating. And if I'm thinking of the Robinhood, I listened to some podcasts about that Robinhood card and that tremendous growth they got. I also think there was like a waiting list to get in to get that card. So not only were they going exponentially, they were growing so fast that if you got in line, you were queued up and you couldn't get it the next day just because that growth has been so powerful. And then what the 4% rewards or crypto that you get back on that Coinbase card. I've listened to a few different podcasts tied to the stablecoin, the Genius Act, and the ability to pay those rewards. And there was a lot of discussion now how the bankers are trying to get that carved back out because they missed it when it got put in. They didn't comment on it to the point of how it might impact them, and they're starting to see these exact things that you're pointing out, that it's pulling away deposits. And then lastly, on a brained up here, the banking with interest, which the host of that podcast formerly was the editor of the American Banker, and he had a guest on who made reference to a treasury survey of some sort that talked about the risk of Coinbase actually eating up a third of deposits. And if you think about that, while you're trying to grow, while you're having challenges getting the younger folks into the credit union, and the money's transitioning from the baby boomers who are passing it on literally to the younger generation. You don't want to quote Mark McWaters, a former board member, credit unions don't want to be like the horse and buggy, right? Everything's fine. These automobiles aren't going to turn into anything that we have to really worry about, right? Lot of pressures out there, and that merger thing. I mean, you can stay away from having to be one of those strategic mergers, but if you don't pay attention and get in the game, you might find yourself having to be one of those strategic mergers.
Yeah, I mean that's my merger consultations with clients now. I mean, what I'm advising is if you look ahead, you need to position this industry is going to consolidate along this challenge. Who is solving this next gen gap and who is struggling to? So if you want to be a successful acquirer, I think looking forward, you need to show that you have a mix of products and services that is resonating with younger generations. You need to show that you've made progress with that engagement, and that will make you an attractive acquirer. And Chip Filson and I are on different sides of this issue. Obviously, I am someone that supports strategic consolidation and tries to make deals happen in this market. He's someone that seems to be very critical of the industry's consolidation, encouraging them to resist it. But I take a lot of his criticisms to heart, and I do think he has some good ones. And he's out here today, not to name names, but he's criticizing one where he feels like it's being marketed to members of the emerging credit union as they're getting some sort of products and services pickup through this combination. And the fact is, when you take it apart, it's the same products and services they already have.
Sure.
And I've seen that in some of my discussions where that products and services discussion is not really that apparent in terms of the combination generating actually new, different, or better products and services for the emerging credit unions members. I think that the combination often results in an institution that's more stable, that is got more efficiency and the ability to be more profitable. But from a member experience standpoint, it's not always completely evident. I think it needs to be going forward on this issue. Do does the combination form a combined institution that's going to be more successful reaching out and engaging to millennials and Gen Z? And it has to have products that speak across a range of the needs of those generations. And if I could sum up what those needs are, it's personal financial management tools, not YouTube videos about making a budget, but actual tools that are tracking across accounts, including external accounts, that are showing you your spending, that are showing you your subscriptions that you're spending on, that are showing you your trends, when you might be spending more in a given month or period of time than you historically have been, and losing track relative to your goals, helping you keep track of and calculate the progress of your net worth, giving you encouragement when you're, showing when the system can see you demonstrating good financial habits, and giving you warnings when you're not. Those type of things are out there. Some credit unions are deploying them. Any credit union that wants to be successful with these generations needs to, in my opinion. I've talked about the investment offerings. I just think if you're not willing to give these generations the ability to control their investments at your financial institution and access to a number of different assets on those platforms, I think you're going to lose to these firms that we've been talking about. These generations are heavily debt burdened. The student loan burdens are very significant, especially for Gen Z, more significant than any other generation had to deal with. The mortgage balances are going to be higher. We can see that. Buy now, pay later is creating a really fragmented system of liabilities that need to be managed and are easy to lose track of. Debt advice management and consolidation tools, the top that are available, ought to be provided. First time home buying programs, very important, but also programs that help them plan and navigate that journey, because it's a longer one. And if you let them work with another group in terms of, how they're going to save to get there, how they're going to budget to get there, you really don't have a good claim to the financing when they get there.
Sure.
You can show up and say, we're people helping people, but, they're just going to ask, how did you help? And I think, credit unions need to get into the lives of these generations in a really active way with good tools, with good systems. And then you need to build a community as well. And the communities that these generations are building are on social media. I kind of got interested in financial social media during the meme stock phenomenon, the GameStop phenomenon.
Sure.
I didn't participate in it, but I certainly obviously watch markets closely. And, to see these young retail investors squeezing these hedge funds and pumping this obscure stock to the moon, it just was such a curiosity for me that I started to pay attention to their networks on social media to see what was going on. And I've been watching it with respect to the blockchain and the assets that trade there. And what they do is they form communities around this activity. Now, I'm not suggesting credit unions should be promoting these sort of hyper
Right.
speculative activity, but what I am pointing out is they're going on platforms like Discord, like Reddit, like X, Instagram, TikTok, and they're creating communities where they're talking about their finances. And I think credit unions ought to think about something as well, where they are basically hosting chats. Their certified financial counselors are taking questions, interacting. Their staff are adding to the community discussion, and they're creating interactive communities. I think that's what you need. That, the community formation is not going to be as much in the branch, although I don't think branch networks are irrelevant even to these generations. I think they like to know that it's there, even though they don't use it. Um, but if you want community, at your credit union among your members. Social media is a great tool to get there, and other industries are using it, and they're not big. The latest meme coin or blockchain asset is not a big enterprise. It's a very homegrown grassroots one. And credit unions should look at that model and start to participate in it. And then, the younger generations love rewards. So give them, they want to be rewarded for their business and their loyalty. So give them reward programs and gamify it a little bit. So as they get closer to a reward, they're getting instant gratification
The
and
dopamine.
encouragement.
Yeah, the dopamine. Right.
I mean, one of the things about that Coinbase card, Mark, that I like is every time I buy lunch, by the time I sit down to eat it, I have a notification on my phone with how much Bitcoin I stacked. 40 cents a Bitcoin. But but I like that. I noticed I like that.
Yeah.
And my Amazon points, they just accumulate somewhere. And once a couple times a year, I log on to Amazon. I actually don't shop that much, and I see, oh, I don't have to pay for anything basically that I buy on Amazon because based on my shopping, I always have points to cover, which is nice.
Sure.
But it's very much in the background for me. I know it's there, but I'm not really seeing it on a day to day
Yeah.
basis.
Yeah.
Coinbase is putting their rewards in front of me every time I get one. And I like it. It's kind of a good feeling. So I think that you got to take some cues from that. And those things are all doable.
Yeah.
There's no reason any credit union can't do them. It's just you got to have the awareness of what these generations want. You got to have the willingness. My suggestion would be, if you're listening to this, you're a credit union and you want to take this subject seriously, I'd ask you, who are those voices of these generations in your management meetings, in your boardroom? Do you have one? Is it a token voice that's, being polite relative to the others in the room? Or are they really asserting themselves? And if you don't have that voice, you ought to get it. Bring it
Yeah.
in externally. And I guess that's me raising my hand and my
Right.
team
Yeah.
raising our hand. We're looking to talk to our clients about this next year. I think this is going to be this is a challenge that's going to divide this industry between those that thrive and those that don't, and it's going to direct the consolidation. Listen, I understand people don't like when there's fewer credit unions, but the fact is, if you're serving fewer members, you don't need as many credit unions. And half the credit unions in this industry are serving less members today than they did 5 years ago. The market's going to rationalize that. Yeah, I mean, you can complain about it, but that's just, yeah, I don't know how you can
Reality.
expect otherwise.
Yeah, that's a great summary. This has been a lot of fun, Dan. If someone has listened to this and they want to talk to you and your team about, how they can tap into some of these things, or if they're looking to, they feel they're already positioned to do some of this and they're looking to grow through mergers and things, what's the best way for someone to connect with you and your team?
Yeah, you can reach out to us on our website, info at oldenlane.com. We'll go to all the partners. Of course, you can reach out to me directly. I'm at Prezioso at oldenlane.com. You can reach out to us on LinkedIn. We're very active on LinkedIn. I myself am on LinkedIn as well as our company. We post very frequently about the industry. So follow us and reach out. And yeah, we love to talk to credit unions. Obviously, we have a lot of passion for these subjects, and I think we're pretty well researched on it. And we have a good track record prognosticating the next trend here. So, reach out, talk to us. We love to have these conversations.
That's great. I really appreciate your time today, Dan.
Thanks, Mark. Be in touch. Have a good one.
You
Bye.
got it. And listeners and watchers, I want to thank you for listening. As always, this is Mark Treichel signing off with flying colors.